Most people treat a market crash the way they treat a car accident, something that happens to other people until suddenly it's happening to them and they have no idea what to do with their hands. That's not a knowledge problem, it's a preparation problem. And preparation, not prediction, is what separates the wealth builders from the wealth destroyers in a downturn. Let's start with where we actually are. In 2026, recession probability is not a fringe idea. Central banks spent years fighting inflation with aggressive rate hikes, and the lag effects of tight monetary policy are still working through the economy. Corporate earnings are under pressure. Consumer credit stress is rising. Housing affordability remains at generational lows. Whether a technical recession arrives in the next 6 months or gets pushed out to 2027, nobody knows that with certainty, and anyone who claims otherwise is selling something. What we do know is this: volatility is elevated, market drawdowns are possible, and the cost of being unprepared is real. Now, here is what the Stoics understood that modern investors consistently forget. The event itself is almost never what destroys you. What destroys you is your response to the event. Marcus Aurelius wrote in his Meditations, "This is a man who governed the Roman Empire through plague, war, and economic collapse." He wrote, "You have power over your mind, not outside events. Realize this, and you will find strength." That sentence is not a bumper sticker. It is the architecture of a wealth protection strategy. Because here is what happens in a real crash. Markets drop 30, 40, 50%. The financial media becomes a wall of red. Smart-sounding analysts explain with great confidence why this time is different and why the bottom is still far below. Your account balance shrinks to a number that triggers something biological in you, a survival response that evolution wired in long before there were stock markets. And that biological response screams, "Get out, sell, stop the pain." The people who listen to that scream are the ones who lock in their losses, miss the recovery, and spend the next decade telling anyone who will listen that the market is rigged. The people who don't listen, not because they're emotionally numb, but because they have a system that overrides the panic. Those are the people who come out the other side with more than they started with. So here is the STOLVEX Crash Protocol. 4 components. You build this now, before the crash, not during it. Component 1, the negative visualization. This is premeditatio malorum made practical. Before the market moves another dollar, I want you to do something uncomfortable. Open your brokerage account. Look at your total portfolio value. Now calculate what 40% of that number is. That's your potential drawdown in a severe recession. Write the smaller number down. Sit with it, not to catastrophize, to inoculate. The Stoics practiced this deliberately because they understood that imagining a loss removes its power to paralyze you. When your portfolio actually drops, your nervous system has already processed a version of this. You are not encountering the unknown. You are executing a plan you already rehearsed. This single exercise, done once, seriously, is worth more than 100 motivational videos about staying calm. Component 2. The liquidity layer. Before you can hold through a crash, you need to be structurally capable of holding. Most people can't hold because they have no buffer. When their income gets disrupted, when layoffs happen, which they do in recessions, they are forced to sell assets at the worst possible moment to cover living expenses. This is not an investment failure, it is a system failure. The fix is an emergency fund that covers 6 to 9 months of essential expenses held in cash or a high-yield savings account, completely separate from your investment accounts. This is not money that earns. This is money that protects. It is the foundation that allows you to hold your positions when everyone else is liquidating. Without this layer, you are not investing. You are gambling with money you might need next month. Component 3. The allocation anchor. You need a target allocation that you have decided on in advance in a calm state and committed to in writing. Not what feels right on a random Tuesday when markets are up. Not what your brother-in-law recommends when he's panicking. A written, predetermined allocation. The percentage of your portfolio in equities, in bonds or equivalents, in cash, That reflects your actual time horizon and your actual risk tolerance, not your aspirational risk tolerance. There is a difference. Most people discover their real risk tolerance the first time they watch their account drop 20% in a week. Write yours down before that moment. And then, this is the critical part. When the crash comes and your allocation drifts because equities have fallen, you rebalance back to target. You systematically buy more of what has fallen, not because you know it will recover tomorrow, because your system says this is the allocation you decided was right for your goals, and you are not letting a news cycle override a reasoned decision you made in a clear head. Component 4, the input blackout. This is the hardest one for most people. During a severe market drawdown, you need to dramatically reduce your financial media consumption. Not because information is bad, because in a crisis, the ratio of signal to noise in financial media collapses to nearly zero. What floods in is fear, speculation, and confident predictions from people who were wrong before and will be wrong again. Epictetus taught that we suffer more in imagination than in reality, and financial television is an imagination amplification machine running at full power during a crash. Set a rule in advance. During periods of elevated volatility, you check your portfolio once per week, not once per hour. You read primary sources, Fed statements, earnings reports, economic data releases, and you mute the commentary. You make decisions based on your pre-built system, not on the emotional temperature of people who are paid to keep you watching. Now let's talk about what you actually do with your investments during a downturn, and let's be clear about what this is and what it isn't. This is a framework for thinking, not personalized financial advice. Your specific situation, your age, your income, your obligations, determines your specific moves. What the framework says is this: a market crash is a sale. Every dollar you invest when quality assets are trading at depressed prices buys you more future value than the same dollar invested at peak prices. This is arithmetic, not optimism. If you have a long enough time horizon, and if you're building a real future, you do, then a crash is not a threat to your wealth. It is an accelerant if you have a system that lets you act while others are retreating. Dollar cost averaging into a low cost, broadly diversified index fund through a crash is one of the most well documented wealth building behaviors in the history of markets. You do not need to time the bottom. You do not need to identify the right sector or the right stock. You need to keep buying consistently at regular intervals through the noise. The system does the work. Your discipline is what keeps the system running. Seneca wrote, "It is not that I'm brave, it is that I know what deserves my fear." A temporary drawdown in a diversified portfolio held over a long time horizon does not deserve your fear. What deserves your fear is being the person who had no system, who panic sold at the bottom, who stepped out of the market and watched the recovery happen without them. That outcome is the one worth protecting against. And the protection is built now in the quiet before the storm, not scrambled for in the chaos of the storm itself. This is the Stoic edge. While the market is pricing in fear, the disciplined builder is executing a plan. While everyone else is asking what is going to happen, the person with a system is asking what they are going to do. And they already know the answer because they wrote it down before the crisis arrived. So here is where I leave you, not with a prediction, not with a stock tip, with a question and a task. The question: if the market dropped 40% tomorrow, do you have a written plan for exactly what you would do? Not a feeling, a plan. If the answer is no, that is the only thing on your financial agenda this week. Build the 4 layers: the negative visualization, the liquidity buffer, the written allocation anchor, and the input blackout protocol. Write them down, date them, then put them somewhere you will find them when you need them most. The Stoics did not build their equanimity in the moment of crisis. They built it in the quiet beforehand, through deliberate practice and honest preparation. That is what STOLVEX is here to help you build. Not a portfolio that never drops, that does not exist. A mind and a system that hold when everything around them is moving. If this kind of iron calm, substance first thinking is what you want more of, subscribe to Stolvex and join the newsletter. Every week, we build the system a little further. That is the only way real wealth is constructed, one disciplined layer at a time.